Hello viewers, how are you? During this meeting, I'm going to discuss that what are the different ways through which the manager can enter into the new industry. And we are going to discuss about the internal new ventures, acquisitions, and the joint ventures. So let me share a slide with you. What are the attractions of the new internal ventures? And I will stop my video. Internal new venturing is typically used to implement the corporate level strategies. When a company possesses one or more distinctive competencies in its core business model, and that can be leveraged or recombined to enter into the new industry. That can be any technology. And normally in the information IT based companies, they can start up the new product in the new industry on the basis of their technological competencies. Internal new venturing is the process of transferring resources to and create a new business unit or division in a new industry. Internal venturing is used most by the companies that have a business model based upon using their technology or design skill to innovate new kind of products and enter related markets or industries. Thus, technology-based companies that pursue related diversification are most likely to use the internal new venturing, and a company may also use internal venturing to enter a newly emerging or embryonic industry. These are those industries in which the no company has yet developed the competencies or business model to give it a dominant position in that industry. Embryonic industry example, when the new technology comes in. Let's say in the case of the color, when the color television come, when the LCDs come, when the LED come, the smartphone comes. So these are the new technologies based product come. So these are the embryonic industries. And what are the pitfalls of the new ventures? Three reasons are often put forward to explain the relatively higher failure rate of the new internal ventures. Market entry on too small scale, a poor commercialization of the new venture, and a poor corporate management of the new venture division. First, we are going to discuss about the scale of the entry. So research suggests that large-scale entry into a new industry is often a critical precondition for the success of the new venture. In the short run, this means that a substantial capital investment must be made to support a large-scale entry. Thus, there is a risk of major losses if the new venture fails. Large-scale entrants rapidly realize scale of the economies, build brand loyalty, and have an access to the distribution channel, all of which increase the probability of a new venture success. In contrast, small-scale entrants may find themselves handicapped by the high cost due to lack of scale of economies, lack of market presence, limits the entrant's ability to build brand loyalty and gain access to the distribution channels. These scale effects are particularly significant when a company is entering in an established industry in which they already have established player. And these established players have a scale of the economies, brand loyalty, and access to a distribution channel. In that case, the company need to make a large investment if they're entering into the mature industry. If you look into the figure 10.6, the relationship between profitability and between scale of entry over a time for successful small and large scale venture. The figure shows that successful small scale entry is associated with lower initial losses, but in the long run, large scale entry generates greater returns. And however, because of the high cost and risk associated with large scale entry, many companies make the mistake of choosing a small scale entry strategy, which often means where they fail to build the market share necessary for the long-term success. Okay. And the another pitfall is the poor commercialization of the new venture of the product. Many new internal ventures are driven by the opportunity to use a new or advanced technology to make better product for customers and outperform competitors. But to be commercially successful, the products under development must be tailored to meet the needs of the customer. Many internal new venture fail when a company ignores the needs of the customers in the market. Thus, a new venture may fail because it is a marketing a product based on technology for which there is no demand, or the company failed to correctly position or differentiate the product in the market to attract the customer. So it's quite important for the company if they are developing a product on any new kind of a technology, so they can educate the customer to buy their product, or they can otherwise that if the product is not meeting the needs of the consumer and meeting the needs of the convenience of the consumer, so it's difficult for them to commercialize that product successfully. Third pitfall of the new internal venture is the poor implementation. That managing the new venture processes and controlling the new venture division creates many difficult managerial and organizational problems. For example, one common mistake some companies make to try to increase their chances of introducing successful product is to establish too many different internal new venture division at the same time. So if they are starting up so many new internal ventures, so that is basically uh, increases their difficulty of implementing new internal ventures in different industries. Another common mistake is when corporate manager fail to do too extensive advanced planning necessary to ensure that the new venture business model is sound and contains all the elements that will be needed later if it is to be succeed. And the failure to anticipate the time and the cost involved in the new venture process constitute a further mistake. So these are the, for example, the best time. What is the best time to enter into the industry, and what kind of a cost involve the future planning of the cost incurred. That is also a requirement for the internal new venture. Now, in order to address these pitfalls, there are certain guidelines for successful internal new venturing. To avoid the above pitfall, a company should adopt a well thought out structured approach to manage the internal new venturing. New venturing is based on a research and development. It begins with the R and D. R means exploratory research necessary to advance basic science and technology, and developmental research to identify, develop, and perfect the commercial application of a new technology. So companies can take a number of steps to ensure that the good science ends up with a good commercially viable products. So many companies must place the funding for the research into the hands of the business unit managers who have the skill or know how to narrow down and then select the best set of the research project. A company top manager must work with the research and development scientists to continually develop and improve the business model and strategies that guide their efforts and make sure all its scientists and engineers understand what they have to do to make it succeed. And company must also foster close link between the R&D and marketing to increase the probability that the new product will be commercial success in the future. And company should also foster close link between R&D and the manufacturing to ensure that cost-effective manufacturing of the product. And a company should construct an efficient scale manufacturing facilities and give marketing a large budget to develop a future product campaign that will build market presence and brand loyalty quickly and well in advance of that product's introduction. So these are the some guidelines for the successful internal new venturing, where the top management have a good relationship with the R&D, and R&D have the good relationship with the marketing and the manufacturing function of the company. Now, the second way through which the companies can enter into the new industry is an acquisition. Acquisitions are the main vehicle that the company use to implement the horizontal integration strategy. And they're also a principal way companies enter new industry to pursue vertical integration and diversification. So it is necessary to understand both the benefits and risk associated with using acquisitions to implement a corporate level strategy. So in general, acquisitions are used to pursue vertical integration or diversification when a company lacks the distinctive competencies necessary to compete in a new industry. So it uses its financial resources to purchase an established company that has those competencies. Entering a new industry through internal venturing is a relatively slow process. Acquisition is a much quicker way for a company to establish a significant market presence. Because if the company is going to buy an established brand in that industry, it is a much faster way to come to have a presence in that industry. And if the company lacks those kind of a competency which is necessary in that industry, and if they are acquiring a company which have those kind of a competency, this is also a more appropriate way to enter into that industry. And acquisitions are often perceived as less risky than the internal new ventures because they involve the less commercial uncertainty. Because if there is an already established brand in that industry, that established brand has a certain profitability, and they has a profitability stream and brand awareness in that industry. Due to that profit stream, one can estimate about the profit of that company in comparison to the new company, which is going to build their brand and which is going to generate the profits. So it is less risky than the internal new ventures. And because for the new internal venture, it is difficult to predict their future successes and profitability. Acquisition is an attractive way to enter into the industry that is protected by the higher barriers to entry. When the entry barriers are high, it may be very difficult for a company to enter an industry through internal new venturing because it will have to construct large-scale manufacturing facilities and invest in massive advertising campaign to establish the brand loyalty. Difficult goals that require huge capital expenditure. For example, in case of telecommunication companies, it requires a huge investments in terms of infrastructure. So for companies who want to enter into those industry which is a high entry barrier, so acquisition is a more favorable way, and acquisition is more appropriate way to enter into those industries. And what are the acquisition pitfalls? Acquisitions have long been the most common method that the company use to pursue the diversification. However, acquisition may fail to raise the performance of the acquiring company for the following reasons. First is companies frequently experience management problem when they attempt to integrate the different companies' organization structure and culture into their own. Once an acquisition has been made, the acquiring company has to integrate the acquired company and combine it with its organizational structure and culture. And this kind of integration involves the adoption of the common management and financial control system, the joining together of operation from the acquired and the acquiring company, and the establishment of the bureaucratic mechanism to share information and personnel, and the need to create a common culture. And these are some challenging tasks. So after an acquisition, many acquired companies experience high management turnovers because their employees do not like the acquiring company's way of operating, their management philosophy, their structure and culture. And research also suggests that the loss of management talent and expertise and the damage from constant tension between the businesses can materially harm the performance of the acquired unit. So this is the one reason for the failure of the acquisition when the companies have not been integrated well. The second is overestimating the economic benefits. So companies often overestimate the potential economic benefit from an acquisition, and they often overestimate the comparative advantages that would derive from the acquisition, and so pay more for the acquired company than it is worth. One reason is that top managers typically overestimate their personal general competency to create valuable new product from an acquisition. The very fact that they have risen to the top of the company gives manager an exaggerated sense of their own capabilities and a self-importance that distorts their strategic decision making. So that is the one reason when they are overestimating their economic benefit, and they are basically doing it for the wrong reasons. Second is expense of acquisition. Perhaps that's the most important reason for the failure of acquisition, is that acquiring a company where stock that is publicly traded tends to be very expensive. I'm talking about the public listed companies, and the expense of the acquisition can more than wipe out the value of the stream of the future profits that are expected from the acquisition. तो जितना आपको फायदा उससे मिलना है, उससे ज़्यादा महंगी कीमत की अगर आप एक्विजिशन खरीद लेंगे तो उसका फायदा जो होने वाला होगा वो उतना फायदा नहीं होगा जितने आपने महंगी एक चीज़ खरीद ली है. So one reason is that top manager of the company that is targeted for acquisition are likely to resist any takeover attempt unless the acquiring company agrees to pay a substantial premium above its current market value. And these premiums are often 30 to 50% above the usual value of the company. अगर एक कंपनी जिसको आप एक्वायर करना चाह रहे हैं उसके मैनेजर को पता चल गया कि आप बहुत ज़्यादा इंटरेस्टेड हैं तो वो रेजिस्ट करते हैं और उसकी प्राइस को बढ़ाने की कोशिश करते हैं. And the reason why the acquiring company must pay such a high premium is that the stock price of the acquisition target increases. enormously during the acquisition process, as the investor speculates on the final price of the acquiring company will pay to capture it. Or in the case of the contested bidding contest, where two or more companies simultaneously bid to acquire the target company, the stock price may surge. तो जितना लॉन्ग प्रोसेस हो जाएगा एक्विजिशन का, उतना ही उनको मौका मिलेगा स्पेकुलेटर्स को कि वो उसकी प्राइस को और ज़्यादा बढ़ा के स्पेकुलेट करें, और अगर एक से ज़्यादा कंपनी उसमें इंटरेस्टेड होंगी तो हो सकता है उसकी एक इन्फ्लेटेड प्राइस पे कंपनी खरीदे जो कि ज़्यादा महंगी हो और उससे उनको बेनिफिट उस तरह का प्रॉफिट ना मिल सके. Fourth point is inadequate pre-acquisition screening, and researchers have discovered that one important reason for the failure of the acquisition is that manager make the decision to acquire other companies without thoroughly analyzing potential benefit and costs. In many cases, after an acquisition has been completed, many acquiring companies discover that instead of buying a well-managed business with a strong business model, they have purchased a troubled organization. आपको लगा कि दिखने में सरफेस लेवल पे आपको कंपनी ठीक लग रही थी, लेकिन जब आपने खरीदा तो आपको पता चला कि इसके अंदर तो बहुत सारे प्रॉब्लम है, उसके बिजनेस मॉडल के अंदर बहुत सारे प्रॉब्लम्स हैं. और फिफ्थ है एजेंसी प्रॉब्लम्स. And manager make acquisition for reasons that have nothing to do with the shareholder value, which is called an agency problem. And managers often have a large portion of their personal wealth tied to the firm they manage, making them undiversified. A move to diversify the firm may not be in the interest of the other shareholder. Manager की अपनी भी कभी बहुत ज़्यादा stocks उनके पास कंपनी के होते हैं, तो डाइवर्सिफिकेशन कई बार रॉन्ग रीजन की वजह से कर लेते हैं. इससे उनको लगता है उनकी टेरिटरी इंक्रीज हो जाएगी, उनकी पर्सनल वेल्थ इंक्रीज हो जाएगी, जबकि अदर शेयर होल्डर की वैल्यू उसमें इंक्रीज नहीं होती. उस एजेंसी प्रॉब्लम की वजह से भी एक्विजिशन जो है वो सक्सेसफुल नहीं रहती. अब नाउ व्हाट आर द गाइडलाइन फॉर द सक्सेसफुल एक्विजिशन? टू अवॉइड द pitfalls which have been described above, and to make the acquisition successful, companies need to follow an approach to targeting and evaluating potential acquisition that is based on four main steps: target identification and pre-acquisition screening, bidding strategy, integration, and learning from experience. So identification and screening. Through pre-acquisition screening increases the company knowledge about a potential takeover target and lessen the risk of purchasing a problem company, one with a weak business model. It also leads to the realistic assessment of the problems involved in the executing a particular acquisition, so that the company can plan how to integrate the new business and blend organizational structures and cultures. An acquiring company should select a set of the top potential acquisition targets and evaluate each company using a set of the criteria that focus on revealing. So these are the five criteria on which the company can evaluate the acquiring company, acquired company, or can evaluate their acquisitions. First of all, its financial positions, balance sheet, income statement, cost, cash flow statements. What are the distinctive competencies and the comparative advantage of the company, and how the industry boundaries are changing? What are the management capabilities of the company, and what is their corporate culture? So once a company has reduced the list of the potential acquisition candidates to the most favored one or two, it needs to contact expert third parties, such as investment bankers. And these companies' business models are based on providing valuable insight about the attractiveness of a potential acquisitions, assessing current industry competitive conditions, and handling the many other businesses and issues surrounding an acquisition, such as how to select the optimal bidding strategy for acquiring the target company stock and keep the purchase prices as low as possible. Second success guideline for success is bidding strategy, and the objective of the bidding strategy is to reduce the price that a company must pay for the target company. And the most effective way company can acquire another is to make a friendly takeover bid, which means the two companies decide upon an amicable way to merge the two companies and satisfying the needs of the each company stockholder and the top manager. A friendly takeover prevents the speculators about bidding up the stock prices. By contrast, in a hostile bidding environment, the price of the target company often gets bid up by speculators who expect that the offer price will be raised by the acquirer or by another company that might have a higher counter offer. Another essential element of the good bidding strategy is the timing. With good timing, a company can make a bargain purchase. For example, the good timing is if the company is struggling with their financial problems or another managerial problem, That's a good timing of acquiring that company. Third is the integration. Even though if the companies have gone through the good screening at the beginning, an acquisition will fail unless the acquiring company possesses the essential organization design skill needed to integrate the acquired company into its operation and quickly develop a viable multi-business model. Integration should center upon the source of the potential strategic advantage of the acquisition, and integration should also involve steps to eliminate any duplication of facilities or functions. In addition, any unwanted business unit of the acquired company should be divested. For example, if the company has not been integrated well in the company, then the company should divest that business unit. Fourth is the learning from experience, and the research suggests that the company that acquire many companies over time become expert in this process and can generate significant value from their experience of the acquisition processes, and their experience enable them to develop some playbook or some rule book which they can follow to execute an acquisition most effectively and efficiently. So these are some guidelines for the success for the acquisition. And let's discuss about the entering the new industry through the joint ventures. And what do we mean by joint ventures? Joint venture where two or more company agree to pool their resources to create new business are most commonly used to enter an embryonic or the growth industry. And suppose a company is contemplating creating a new venture division in an embryonic industry. Such a move involves substantial risk and cost. The company must make the huge investment necessary to develop the set of value chain activities required to make and sell the product in the new industry. In this situation, a joint venture frequently becomes the most appropriate method to enter a new industry because it allows the company to share the risk and cost associated with establishing a business unit in the new industry with another company. And this is especially true when the companies share complementary skills or distinctive competencies, because this increases the probability of the joint venture. एक तो कंपनी का रिस्क शेयर हो जाता है, दूसरा अगर कॉम्प्लीमेंट्री स्किल्स हैं, यानी अगर आपके पास एक कंपनी का डिस्ट्रीब्यूशन नेटवर्क स्ट्रॉन्ग है, दूसरी कंपनी का टेक्नोलॉजी स्ट्रॉन्ग है, तो कॉम्प्लीमेंट्री स्किल्स भी जो होते हैं वो जॉइंट वेंचर की तरफ लेके जाते हैं और जॉइंट वेंचर की सक्सेस को बढ़ा देते हैं. पर कुछ प्रॉब्लम भी होते हैं जॉइंट वेंचर के साथ. देयर आर सम रिजल्टिंग प्रॉब्लम which may arise for the both partner companies. Under some conditions they may result in some problems, and which are, although joint venture allow the company to share the risk and cost of developing a new business, it also requires that they share in the profit if it succeeds. The joint venture may have a different business model or time horizons. For example, if the one company think that the company that due to their distinctive competencies, the companies are making the profits, their share must be greater than the other partner, and this kind of the feeling create problems between the partner as well. Another would be the different business. The joint venture partner may have a different business model or the time horizons, and problems can arise if they start to come into conflict about how to run the joint venture. So if there are certain different ways of managing their organization, different business model, so these kinds of the problem can disintegrate the business and result in the failure of the joint venture. A company that enters into the joint venture runs the risk of giving some important company specific information, some proprietary knowledge to its partner, which might then use the new knowledge to compete with its other partner in the future. So they can lead of some proprietary information, so they can become the competitor in the future as well. So these are some resulting problems of the joint venture as well. And the last component of this meeting is restructuring, and sometimes company need to exit industries to increase their profitability and split their existing businesses into separate independent companies. So restructuring is the process of reorganizing and divesting business units and exiting industry to refocus upon a company's core business and rebuild its distinctive competencies. कोक ब्रूइंग इंडस्ट्री के अंदर गए थे लेकिन वहाँ सक्सेसफुल नहीं हुए थे, उन्होंने कोक ने उस बिजनेस को सोल्ड कर दिया और दोबारा अपने कोक के बिजनेस के ऊपर फोकस किया. इसी तरह कोलंबिया पिक्चर को उन्होंने एक्वायर किया था लेकिन वहाँ भी सक्सेसफुल नहीं हुए, तो वे डाइवेस्ट किया और उसको लॉसेस के अंदर सेल आउट किया और फिर वापस अपने बिजनेस की तरफ आए. Why company restructure? Okay, that's a question. The reason for the restructuring. One main reason that diversified companies have restructured in the recent year is that the stock market has valued their stock at the diversification discount. That means the stock of the highly diversified company is valued lower relative to their earnings. than the stock of the less diversified companies. Investors see highly diversified company as less attractive investment for four reasons. First is about the complexity of the financial statement of the highly diversified enterprise, and that disguises the performance of the individual business unit. Second is the complex. Many investors have learned from the experience that the managers often have a tendency to pursue too much diversification or do it for the wrong reason, and their attempt to diversify reduce the profitability. Or innovation and strategic management have diminished the advantages of the vertical integration or diversification from innovation in the strategic management. So that is also some of the reason due to which investors see that the highly diversified company are the less attractive investment for them. Okay, so that's it for this chapter and for the diversification and the diversification and related strategies and how the companies can enter into the new industry through different ways. And if you have any question, if you have any comments, please write it in the comment box and I will look into those things and try to answer your queries about these videos as well. Okay, Allah Hafiz, bye bye. Have a nice day.